Hello students, I am Professor Plínio Monteiro, and in this video I will discuss some environmental influences on international pricing decisions. The main elements influencing pricing decisions in international marketing are currency fluctuations, inflationary environment, government controls subsidies and regulations, and finally, competitive behavior. Let's look how these factors will affect the way that you develop your pricing decision. Fluctuating exchange rates can pose a lot of challenge for managing prices in global marketing. Now, suppose that you have a weakening of your home country currency. This means that you can export the same products and achieve a very high profit with the same volume sold. Or, for instance, you can reduce your price for foreign markets, and then you're going to have to achieve a lot of market share, and with that you can have, in both cases, you can have a lot of profit. Of course, most of times companies you try to make a balance. For instance, since suppose that the currency in Brazil is devaluating compared to dollar, then what happens to Brazilian commodities? Then you're going to export more of these products. And sometimes the exporters here in Brazil will increase a little bit the price in reais, and at the same time the price will be still very attractive in dollars, and they will increase their market share and at the same time increase their profits. But let's look to the opposite example. When you have the increase of the value of your home country currency. In that case, to achieve the same profit, it will be necessary to increase the price in foreign markets. Sometimes companies will try to make some arrangement to avoid that. For instance, they can keep the price at the same level and wait for a better time to receive back the payments of these profits, or they can use some financial arrangements, and very similar to insurance. And this kind of financial arrangement will allow you to reduce the risk of currency fluctuations when you try to sell abroad. And nowadays, it's especially very hard to increase the price in one country into another when you try to enter with your product in different countries in the world, given that people have access to prices in different countries. So this is what we call the price transparency. And price transparency will make it more difficult for your business to apply different pricing schemes in different countries. And what strategies can you apply given this currency fluctuation? First, let's look to the example when you have a weakening in your domestic currency, your home country currency. In that case, you can stress the price benefits. For instance, you can tell to your customers that you have very attractive prices. Or you can expand your product line and add more costly features. This means that you're going to have more products with more characteristics, and of course you're going to increase the price in home and foreign market currencies. And by adding these new features and new products, then you're going to increase your profits. Also, you can shift the sourcing to domestic market. This is the idea to reduce, since suppose that you're paying a lot of money to produce in different countries in the world. So if you have a weakening in your domestic market, you can start producing more in your home market, your domestic market, because the cost will be reduced to the production in general, increasing your profits. Also, you can look to more opportunities abroad. So if your currency is weak, then you can move to different countries and try to find opportunities in these new markets. Then you can use a full costing approach, but employ marginal cost pricing to penetrate new or competitive marketing. So what is that? In that case, you're going to focus in the cost of production and use that as a basis for your pricing. And since you have low cost of production, given the reduction of your domestic currency, you can use that to increase your penetration in different markets abroad. Also, suppose that you have profits in different countries that you still not bring back this profit to your country. So if you have a reduction on the value of your domestic currency, then it's time to bring back the profit, because the same value, the same money that you have abroad, you represent more money in your domestic currency. This is the case of speed repatriation of foreign earned income and collections. 7. You can minimize expenditures in local or host country currency. So this means that if you reduce the cost of your product in home country, then in the host country, you can, or in other countries, in different countries in the world, so you're going to use more investments in using your weak currency in your domestic market. In that case, you're going to reduce even more the cost of your overall operation. You can buy advertisement, insurance, transportation, and other services in domestic market. This means that you're going to pay to local producers, so people in your domestic market. So basically, you're going to reduce your costs compared to the earnings that you can have selling to different countries in the world. And finally, you can bill foreign customers in their own currency. Since your domestic currency is weak, then you can ask your customers to pay in their own currencies, and this can increase your profit. And then, if your domestic currency is becoming more strong compared to the hard currencies in the world, like dollar and euro, what you can do? First, you can move to from a pricing competition to a non-pricing competition, basically by improving quality, delivery, and after-sales services. Another action that you can do is to try to increase your productivity, basically increasing the outputs given the resources that you use in your factories, and with that you can also search for cost reduction. And this is one way to keep your costs lowered, and this will allow you to keep your profit even when you have a smaller price in your domestic currency. Also, you can shift your production from home to foreign markets. So if it's costly to produce at home, then you can start moving and producing in foreign markets. Also, you can give priority to export or to have business with countries with stronger currencies. So basically, you're going to look to these countries with a strong currency and try to export to them. Also, you can trim your profit margins and use your marginal cost pricing, and basically this means that you're going to accept smaller profits for your business. Also, you can keep the foreign earned income in the host country. So you let the profit there, you let the profit of your business there, and then you're going to wait for a better time, basically when your currency is not so strong, to return your profit to the home market. You can maximize expenditures in local and host country currency. So what this means? If it's too costly to make investments in your home country, then you're going to make investments in the foreign markets. And this will be cheap to you. You will reduce the cost for your entire operation. Also, you can buy a lot of products abroad. So if you usually hire people to make your logistics, your insurance, or your marketing, and if you usually do that in your home country, then you're going to start to hire people in foreign markets for do these services for you. Since it will be less expensive to hire people in foreign markets, this will keep a relatively good level of profit for your business. And finally, you can bill foreign customers in your domestic currency. So if your domestic currency is expensive, so you can ask your customers to pay your business using your currency, and then you're going to avoid these currency fluctuations, especially in this case when your currency is strong. The inflationary environment can also be very challenging for international marketing managers. And basically, inflation is it's defined as a percent upward change in price levels. And sometimes this can be related to the increase in money supply, basically when central banks start printing a lot of money to pay the bills of the government. And sometimes this can be caused by the currency devaluation. Basically, when you have people are not trusting in the accountability of the country, and they don't believe that the country will pay the bills in the future, and this can cause a lot of currency devaluation. And of course, when you have inflation in different countries, this can pose challenges for defining the price in these different regions. Of course, when you have inflation in the country, you need to have more frequent adjustments in your price just to try to keep your operating margins. And by the other hand, sometimes you can have very low inflation, and the existence of low inflation can also be a challenge because once you have more stability in prices, it will be more hard for you to increase the price even when you try to add new products in the market with new features or higher quality. So both cases of high inflation and low inflation can be challenging for international marketing purposes. It's very important also to look to government controls, subsidies, and regulations. This can have a huge effect in the way that you define your pricing decisions. So look to the dumping legislation to see if your pricing level can be interpreted as dumping when you're trying to sell a variable price in a foreign market. Also, in some countries, you have some restrictions in the price resale, in the percentage and the margin of profits that you can have when you resell a product. And you can look to that in different countries to see if what will be the final price for your customer. And other countries, you can have price ceilings. For instance, you can in some sectors you have the maximum price, the maximum and the minimum price that you can ask for in a given market, and especially in countries with a lot of government regulation. But sometimes even developed countries like Germany usually apply that to in certain sectors to reduce the price competition. And also see what are the laws and the general regulations about the price levels and the price policies in each country. For instance, what kind of pricing? Sometimes some types of pricing strategy cannot be applicable in some countries because they can be considered illegal. Just to give an example, in Brazil, until recent years, was not possible to give discounts for if you're trying to buy the product in cash. And nowadays, if you're trying to buy the product in cash, you can have a discount compared to the price in a credit card, for instance. The last factor to analyze that can influence your pricing strategy is the competitive behavior. So look to the competition in each country and see if they are going to adjust the price regularly. So if you have competitors that are not changing their price very fast, this can make it more difficult for you to adjust your own prices. And sometimes this can harm your operating margins. And if you have competitors that are manufacturing or sourcing in a lower cost country, for instance, if you're operating in a developing country, but there in this developed country, you have some competitors that produce the same product in a country with a very low cost to production, like a very low cost of labor, of investments. And in that case, you sometimes need to cut your price to compete with these companies that are outsourcing their production. The objective of this video is to present the four main challenges and factors that can influence the way that you develop your international marketing, international pricing strategy. And this is it. See you in the next video. Bye.